The final part of Lecture Series 24, or Bite-Sized Corporate Reporting, focuses on recognition, measurement, and presentation of deferred tax as set out in IAS 12 income taxes, starting with taxable and deductible temporary difference. When the carrying amount exceeds the tax base, this gives rise to a taxable temporary difference, resulting in the recognition of a deferred tax liability. Thus, when the tax base exceeds the carrying amount, the temporary difference is a deductible temporary difference, giving rise to a deferred tax asset. A deferred tax liability shall be recognized for all taxable temporary differences, except to the extent that the deferred tax liability arises from 1. The initial recognition of goodwill, or 2. The initial recognition of an asset or liability that is not a business combination and at the time of the transaction affects neither accounting nor taxable profit and does not create equal taxable and deductible temporary differences. Likewise, a deferred tax asset shall be recognized for all deductible temporary differences, except to the extent that the deferred tax asset arises in relation to item 2 of the previous slide. IAS 12 further stipulates that a deferred tax asset shall only be recognized to the extent that it is probable that taxable profit will be available against which the deductible temporary differences can be utilized. In determining the deferred tax liability or asset, the tax rate applied should be that in force or expected to be in force when the asset is realized or the liability is settled. IAS 12 stipulates that this rate must be based on tax rates or tax laws that have been enacted or substantively enacted at the reporting date. The deferred tax amount recognized in the profit or loss and other comprehensive income represents the movement in the net deferred tax liability or asset, that is the difference in net deferred tax liability or asset at the beginning of the reporting year and at the end of the reporting year. So, where is deferred tax expense or income recognized? IAS 12 stipulates deferred tax expense or income shall be included in the profit or loss for the period if the item giving rise to the deferred tax is recognized in the profit or loss. Accordingly, if the item giving rise to the deferred tax is recognized in other comprehensive income, the related deferred tax should also be dealt in other comprehensive income and held within equity. Finally, presentation. Deferred tax asset or liability is presented as a non-current asset or liability. IAS 12 stipulates that the deferred tax asset or liability shall not be discounted to present value. IAS 12 permits offset of deferred tax assets and deferred tax liabilities provided the entity has legally enforceable right to set off current tax assets and current tax liabilities, and the deferred tax assets and liabilities relate to tax levied by the same tax authority. With this, we have come to the end of Lecture Series 24 on IAS 12 income taxes, focusing on the objective of IAS 12 as well as the relevant principles relating to the recognition, measurement, and presentation of current and deferred tax. The next bite-sized corporate reporting lecture series will look at IFRS 1, first-time adoption of International Financial Reporting Standards.